Hello again. Now we are moving to the next step and part 2. So we have already defined what is money by its function, medium of exchange, store of value, unit of account, and we gave a little bit of different terminology which is often used for the money. Money must have all those three functionality. However, there is currency, there is fiat currency or fiat money, which only the medium of exchange is considered. And the other functions are either indirectly controlled by the government or central banks, or it's basically undermined. So that was what we have said. Now the question is that, okay, we have a money and it's a legal tender or it's a fiat currency or whatever. How much does it exist in the society? So how we are able to measure the monetary aggregates. Okay, so the supply or demand or total supply of money, how much exists in the society. The best way of explaining the money aggregates, the measurements for the money, is to start with the basics of accrual accounting system, the ledgers and balance sheets, and the accounting identity, which has been written here. So to understand that, the ledger, the ledger is a way of recording that what is being purchased. So if A buys an apple worth this much, it's been recording and it's got a date. So it's a chronology of basically buying and selling or transactions. So that's the meaning of the ledger. And if it's going out of your pocket, it's basically going to be debited. And if it is coming to your, it's going to be credited. So if those of you have done the accounting, we start from the ledger, simple ledger, and then at certain point of time, we develop a balance sheet. And the balance sheet is got this structure, that it is like a T, or we call it T account. It's like a T. In the left side, we list of the assets worth. And in the right side, we break down how much of the values of the items in this list is basically financed by borrowing from the others. So that is the debt or is liabilities. Plus the leftover of the total value minus the liabilities, what is called equities. Equities are the net entitlement, or sometimes it's called net worth. So that is what we have shown in the accounting identity. So assets is always, so it's three line, it's a identity. Assets is equal to liabilities plus net worth. So if you have so many items here which worth, the list of items you have which worth $10,000, and here is also going to be $10,000. How much of this $10,000 you have borrowed from others, from the bank or from the your friends? If let's say 5,000 is borrowed and the leftover 5,000 is your actual entitlements, or it's your equity, it's your entitlement, that the whole asset is belong to you, but if you announce bankruptcy, you have to first pay your debt, and then the remainder is the value of your basically the value which is truly financed by your own resources. So this has been financed by borrowing. This is financed by the owner. So this balance sheet can be for an individual, can be applies for individual, can apply for a family, for a household. We called it household. Firm or bank, or firm. This is a firm or company. Bank, or even central bank. So balance sheet applies for every entity in a society. So these entities are collective units of individuals. Collective units of individuals. Let me give you an example of one person, Mr. Ali. Let me talk about Mr. Ali. Mr. Ali has, he's trying to list his assets. Sorry. So he has got some cash in his pocket. Okay. He's got some cash in his pocket. He's got some deposits, current deposit or a demand deposit. Demand deposit into the bank. So this is his belonging. And he's got some saving account or term deposits. Our savings, and he might have some securities. Securities has two types: bonds, debt securities, or stocks, a company's stocks. Okay, so he might have some valuable papers which promises some money in the future. So all of these has got some worth. I just don't write the value, but they are all in dollar. Okay, saving, securities, and let's move further down. Might be longer term money accounts. So these are money accounts actually. These are money accounts. This is demand deposit. It's the moment he wants to, this is like a debit card. So we list it here. Might be coming to some physical assets, such as a calculator, a computer, a car. So these are valuable items which belongs to Mr. Ali, and he has its market value of that at that moment. It means that if he sells, he can make it money like this. Second-hand car or whatever. And there might be some precious metals. That is also gold, silver. Okay, if he's got some, he would take the value. And then it might come to the house or buildings. Or land. So this is the land is, we put it as the end, okay? Let's say these are the values of. So the total amount is called asset or wealth. This is Mr. Ali's wealth, that he's got so much of dollar worth of assets. So is he purchased all of them from his own income, from his own entitlement, or he might have borrowed for the house he has purchased, he has borrowed some money from the bank and he's paying by installment. So those are considered as liabilities. So he's got certain amount of liabilities, loan from a bank, loan from uncle. Okay, he has to pay these monies. And then after deducting the value, the worth of assets minus liabilities, this is called equities. So equities are entitlements of the person. And if he wants to borrow, he will go either to get a loan or selling a bond. By selling a bond, if it's Ali has a company, he issues a bond and says that whoever purchased this bond worth of $100, at the end of the year, I pay him $110. So additional worth. So this is the bond. So this is considered as financing via or through the debt, through the liabilities, increasing the liabilities. He might actually issue a stock and say, come and buy my $1,000 worth of stock and you become a part of my business. So once I make profit, I share the profit according to the number of shares you have, proportionally, where I distribute the dividends. The dividends is the profit shared with the owners. So if Mr. Ali tries to increase his asset by buying some machines or equipments, okay, so this is also physical. I should have written it below here. If he tries to buy new machines, he could basically issue a bond and promise that I'm paying you 10% back. Or he may say that you give your money, but let me work. And then once the profit is been determined at the end of the year, I share that with you. So this is through the stock. So stock is an equity, but bond is a liabilities. So liabilities increase by selling the bond. Equities are increasing through selling the stock shares. I hope that you understand this. And the reason that I wrote it like this was the following, that I put the cash in the pocket and demand deposit. These are the money inside the bank account, debit account, and then the savings and the securities and the rest like this. So let's say he's got $1,000 worth of cash in his pocket, and he's got like $2,000 worth of money in his bank account. The moment he wants, he can spend any of them. And he's got some savings, let's say 500 saving, but if he touch it, he will lose the interest security and securities and savings has some return. Say the savings has got 2% and the securities has got 10%. But is the cash or deposit has any return? No, it is 0%. And by the way, the liquidity is 100% for these two items, and it is very high for these two items. And there is, for the other items, it becomes lower and lower liquidity, but the return may be higher and higher. So I listed the Mr. Ali's asset portfolio, we call it portfolio. The asset portfolio is being defined from the highest liquid cash and demand deposit and the saving and etc. So if I go down, becomes less liquid, and if I come down, becomes more rate of return. So there is a relationship between the liquidity and the rate of return sometimes, and this is the reason that I did it like this. So this will help us to define the money aggregates. M1 and M2. There are M3, M4 also, but in our book we only focus on M1 and M2. So what is M1? M1 is called transaction money. Transaction money consists of cash and deposits. Deposits which are checkable accounts. Okay, so let's bring the slides and talk on the slides. So that's the definition of the asset, and from the assets we classify the assets to highest liquid is called the transaction money. The transaction money consists of these items: currency held outside banks, the money which is in pocket of you and me, not inside the vault cash of the banks. That is not the transaction money. Currency held outside the banks in the pocket of firms and households are considered as transaction money. Why? Because it's readily available upon the wheel. They can use it as a medium of exchange. So transaction money is readily available for medium of exchange. Like your cash, and also demand deposit. Demand deposit is M1. And traveler's check. These days we don't use it, but it still exists. But these are, you go to the bank and say, in the olden days, I want to go from Muscat to Salalah. I don't want to carry a lot of money. Give me a traveler's check, and once I receive my destination, I take these checks to any merchant. They accept it as a medium of exchange. And usually the collector of the traveler's check take it to the bank, and then the bank is converting it into the cash or deposits. Other checkable accounts. So you might have a checkbook. So you write a check and you order your bank to pay the merchant the money which you are. So all the checkable deposits, demand deposits, traveler's check, plus the currency are considered as M1. It's not for only one person, for the entire population. This is the narrow definition of the money. It's the narrowest definition of the money aggregate, is called M1. M1 is a stock measure, and it is a measure at a certain point of time. So we are as if we are considering the balance sheet of all firms, and then we add them up and say that this is the M1 in the United States. It's $3.6 trillion in March 2008. Then after this, so this was actually, we are summing up only this part of everyone's asset, the M1 type of asset for all. So it consists of cash, it consists of money, demand deposit, checkable deposits, and also the traveler's check. All of them together will give the magnitude of the M1. Now let's move to M2. M2 is a broader definition. So it is equal M1 plus what is called as the near money. Near money. So near money are like savings, like bonds. If the person can convert them to money very quickly, you just go and sell it. You withdraw your saving deposit, and the bank says, I was going to give you 2%, but I'm not gonna pay you. If you sell your bonds, the bonds was paying you 10%, but you have discounted it by basically selling into the bond market. So you may actually sell it below the price or at the price, but in anyhow, the bonds is these are highly liquid, but not 100% liquid. So some of them are like depending on the return or the interest you forego, they have a price. Whereas these ones, it costs you nothing, but they will cost you. And cost in terms of the interest you forego, or the time you spending to make it cash. So altogether the near money are those type of assets. Like for Mr. Ali, we have a bond, stock, or saving deposits, or term deposits. They are all of near money. Mr. Ali can quickly sell these items and make it cash and go and do a transaction for buying something else. Okay, and as a result, altogether is considered M2. Altogether is considered, so near money is a part of the plus the M1 becomes a part of M2. So from here to here is M2. From here to here is M1. Not for only for the Ali, for the entire society. So let me bring the M2. M2 is also known as the broader money, because it's larger amount. M1 is inside it. To understand that, we have to add all the near money with little bit of cost. These are the assets which can be converted to transaction money. Close substitute for transaction money, such as saving account and money market account. Money market accounts are bonds and stocks. Okay, so M2 or broader money is M1 plus all these things: saving account, money market account, or any other near money. So if we give you a table, you can basically identify that which one are the near money, and then you can calculate the M2. So M2 is M1 plus saving account, money market, and other near money. So in the US, in the March 2000, remember that was $3.6 trillion. The M2 is equal to this much. And the central banks have a very accurate number of the amount of M1 and M2. And if you go to CBO, Central Bank of Oman, annual report, M1 and M2 are given how much is it in Oman. So one of the very broad definitions of the money includes amount of available credit on credit cards as a part of money supply. There are no rules for deciding what is or what is not money. Therefore, we are classifying. So we say transaction money this much, M2 is this much, but beyond M2 would be M3, M4, which if you go to Federal Reserve website or Australian Reserve Bank Australia, rba.gov.au, you can see M1, M2, M3, M4 for Australia, for example. If you go to Federal Reserve of US, you can see M1, M2, M3. So these are called beyond M2. So you have to add more and more to simplify the notion. M1 is transaction money. M2 is M1 plus near money. M3, we can say that it's M2 plus farer money. I mean, they don't call it farer money, but I am just to simplify it. M4 is M3 plus even farer. So we can add in the balance sheet of the items, we can rank them based on their liquidity and based on their rate of return, and say that up to here is M1 type, up to here is near money, then a little bit more is farer money, then a little bit more. So we can have M1 and then M2 is this, and then this is M3 and this is M4, etc. So it's always nested. M1 is nested in M2, M2 is nested in M3, and etc, etc. So this is the way that it works. So for our purpose, money will always refer to transaction money or M1. In this book, our most emphasis is on M1. But in some other money and banking, if you take the money and banking with me in the summer, I am explaining which one to be used and when, according to the policies. Okay, I will stop it here, and then I will give you a little bit of historical background of the paper money or fiat currency, and then we can explain how the money supply is, how the modern money is created in the banking system or in the money market. Thank you.